Now, if you have ever taken the trade and got stopped out and then watched the price go exactly where you expected, it's not bad luck. It's because you don't understand how the market actually moves. So the problem is that most traders are taught that the market is random, so they rely on indicators, patterns, signals, but even when they're right, they'll still lose. And it's because they're not actually thinking about what price is doing. This is where ICT comes in. And ICT isn't just a strategy, it's a way of understanding the market and how price moves. So instead of asking, should I just buy, should I sell? You start asking, what is price moving towards? Because price doesn't move randomly, it moves with intent. So the main thing that I'm going to be teaching in this video is liquidity. So what is liquidity? It's areas within the market where a large number of buy or sell orders sit. For example, stop losses, limit orders, pending orders. And this is just a little summary. Buy side is liquidity above highs. So for example, this. Sell side is liquidity below lows. Um, so where does the market actually move to? So the main reasons the market moves is to seek liquidity. So areas like this, these are both areas of liquidity. The second reason is to rebalance to equilibrium. And third is rebalance to fair value gaps. Those two second concepts, equilibrium and fair value gaps, I'll go over in another video. For now, it's just liquidity, and it's a pretty straightforward concept. So at a basic level, the market moves in a cycle. It seeks liquidity, it delivers price, and it forms structure. So liquidity is where traders are positioned, usually above highs and below lows. And structure is how price trends. So higher highs, lower lows, and it shifts in a direction. So here, higher high, lower low, higher high, lower low, higher high, lower low, higher high. And sometimes price moves aggressively and leaves things such as fair value gaps or imbalances, whatever you want to call them. And they are areas which also get revisited later. And these aren't separate ideas, they all do work together. So let's try and find an example on the real charts. Okay, so we're on a 1 hour chart here. Okay, so for example, here, we can see there's a high and another high. These are relative equal highs, okay? So just bear that in mind. Here, we have a low, another low, relative equal lows. Okay, so let's look at what price does. The price is in this range here, and then eventually it comes down here, sweeps these relative equal lows. Now liquidity isn't relative equal lows. Relative equal lows are just a good example of it. So here, price comes down, sweeps it, and look at the reaction. Goes straight back up. Now when price goes up from that, what does it do? It leaves these big candles here. These are fair value gaps. This is again something I'll go over, but it's another form of liquidity. So price comes down, sweeps out this liquidity area, comes back up, forms another form of liquidity in this imbalance, comes down, visits it, goes back up. After it goes back up, where does it go? It targets these two highs, relative equal highs. There's a third one here as well. And here, this candle here sweeps it. And what does it do? Moves back down into the opposite direction, and it moves into another fair value gap. and then goes down, comes back up, sweeps this high, and then creates again fair value gap. Price comes down into it, goes back up, sweeps these highs, creates another fair value gap, and yeah, I'm sure you're seeing the pattern. The main reasons why it moves is to hunt highs and lows, and during that time when they are getting swept, these things here called fair value gaps, they get left behind. It's another form of liquidity for price to target. These are the two main reasons why price moves: to hunt liquidity and to rebalance the fair value gaps. I did mention before equilibrium. Equilibrium is also involved, but it is not as important as these. So just to summarize, price pushes up, takes that liquidity, moves in the opposite direction. Price moves down, takes this liquidity, moves in the opposite direction. And that's not random. That's the market moving towards liquidity first before delivering price elsewhere. Take a look on your charts, try and use a higher time frame. It's just a lot easier to spot, and you'll see for yourself. And when you start noticing this pattern, that's when everything changes. You stop chasing breakouts, you stop getting trapped in trades as often, and concepts like market structure or fair value gaps, order blocks, they start to make more sense because they all fit into this framework. So if you do learn anything from this video, just let it be that the market isn't random. It moves with purpose, and it's often moving toward liquidity. In the next video, I'll break down market structure, which is the foundation for understanding trends and direction, and that's where everything will really start to click.